What if I told you that the silver market, one of the oldest, most traded commodities on Earth, is being deliberately suppressed by a handful of banks holding short positions worth billions, and that a short squeeze in silver could be one of the biggest financial events of this decade? You're going to discover exactly how silver price manipulation works, understand the mechanics of a short squeeze, and walk away knowing precisely which signals to watch for. And by the end of this video, you'll see why the setup forming right now in silver is unlike anything we've seen in over 40 years. I've been tracking this for over 6 years. I've gone deep on the CFTC reports, the Bank for International Settlements data, and the trading patterns that surface every single time silver gets close to breaking out. Drop a comment right now. Do you own physical silver, paper silver, or nothing yet? I want to see where you're starting from. So let me break this down step by step, because there's been a mountain of noise around silver manipulation, and most of it misses the actual mechanism. People talk about it like it's some vague conspiracy, but it's not vague at all. It's documented, it's trackable. And once you see how it works, you cannot unsee it. Here's the deal. The silver market is split into two worlds that most people don't realize exist simultaneously. You've got the physical market, where actual silver changes hands, bars, coins, industrial deliveries. And then you've got the paper market, which is the COMEX futures exchange, where contracts representing billions of ounces of silver trade every single day. And here's the wild part. The paper market is roughly 250 to 300 times the size of the physical market. Think about that for a second. For every real ounce of silver that exists above ground, there are somewhere between 250 and 300 paper claims on that same ounce. That's not a free market. That's a leverage machine. Now let me show you why this matters to you directly. When you can create 300 paper ounces for every real ounce, you can push the price of silver around like it's nothing. Want the price to drop? You dump a massive short position in the futures market. You're not selling real silver, you're selling contracts, paper, promises. But because the paper market sets the spot price, the price every dealer and exchange in the world references, those paper sales drive the real price down. Every silver coin buyer, every mining company, every solar panel manufacturer prices their silver based on what COMEX says. And COMEX is controlled by entities that have every incentive to keep the price suppressed. Here's the thing. I know what you're probably thinking right now. Okay, but who actually does this? This sounds like a Reddit theory. And that's exactly what I thought before I dug into the data. The CFTC, that's the Commodity Futures Trading Commission, the regulator supposed to police this market, publishes something called the Commitment of Traders Report every Friday. It breaks down who holds what positions in the futures market. For years, going back to the early 2000s, these reports showed a concentration of short positions in silver held by just 2 to 4 banks that was unlike anything seen in any other commodity. We're talking about 8 to 10% of the entire global silver supply held short by a small group of commercial traders. JPMorgan Chase was eventually fined over $1 billion. $1 billion for precious metals manipulation in 2020. This isn't theory, they admitted it, but here's where it gets genuinely explosive. A short squeeze. Let me make sure you're crystal clear on what this means because it's the key to everything else. When a trader sells short, they're borrowing something and selling it, betting the price goes down so they can buy it back cheaper later and pocket the difference. A short squeeze happens when the price starts moving the wrong way, up instead of down, and those short sellers are forced to buy back their position to cut losses. And when they buy back, the buying pressure pushes the price even higher, which forces more short sellers to buy back, which pushes the price even higher. It's a feedback loop. It's a chain reaction. And in a market as small and illiquid as silver, the effect can be violent. Think of it like this. Imagine you borrowed your neighbor's car, sold it for $10,000, planning to buy it back for $8,000 when prices dropped. But instead of dropping, cars suddenly become scarce. Prices jump to $15,000, then $20,000. You still owe your neighbor a car. You have to buy one no matter what the price does. That desperation buying is exactly what happens in a short squeeze. Now multiply that by billions of dollars in a few major banks with their backs against the wall. This is what happened in January 2021, partially. Reddit's Wall Street Bets crowd, fueled by the GameStop mania, turned its attention to silver for about a week. Silver jumped from roughly $25 to nearly $30 in days. The mainstream media called it a failed attempt. But here's what they didn't tell you. The squeeze wasn't actually organized effectively because the paper market absorbed it. The banks dumped more paper shorts into the spike and broke the momentum. Real squeeze mechanics require something the 2021 crowd didn't coordinate: physical delivery demands. Now here's the part nobody talks about enough. The real silver squeeze threat, the one that actually scares the big players, isn't from retail traders buying SLV, the silver ETF. It's from the growing movement toward physical delivery on COMEX contracts. Let me explain why this is different and why it matters. Most futures contracts on COMEX never actually result in delivery of physical metal. traders roll their contracts forward or cash settle. The whole system runs on the assumption that almost nobody is going to show up and ask for real silver. But if enough buyers, institutional buyers, sovereign wealth funds, industrial buyers, start standing for delivery, demanding actual physical bars, the system hits a wall. Because remember, there are 250 paper claims for every real ounce. If even 1% of contract holders demanded delivery at the same time, it would stress the system severely. If 5% did it, we'd be looking at a default scenario. And here's something that's been building quietly over the last 3 years. Industrial silver demand has been absolutely exploding. Not because of investors, because of technology. Solar panels alone consumed over 140 million ounces of silver in 2023. Electric vehicles use roughly double the silver of a combustion engine car. The global push toward electrification and green energy isn't a trend. It's a structural shift that's permanent. Silver is irreplaceable in these applications. There's no cheaper substitute with the same conductivity. So industrial demand is a floor that keeps rising, while above-ground accessible silver supply has been tightening. Drop a comment with your prediction. Where do you see silver in 2 years? Under 30? Between 30 and 50, or above 50? I'm genuinely curious, and I'll respond to as many as I can. Now let's layer in something that makes this whole picture even sharper. Central banks have been buying gold at record levels. In 2022, 2023, into 2024, central bank gold purchases hit multi-decade highs. And historically, when gold breaks out and runs hard, silver follows with a vengeance. The gold-to-silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 47 to 1. Right now, it's sitting above 80 to 1. Historically, when this ratio compresses back toward its mean, silver moves faster and harder than gold on a percentage basis. If you've noticed gold making headlines, but silver seeming quiet by comparison, that's exactly the dynamic I'm describing. Silver is coiled. But wait, there's a specific mechanism at work that I want to make sure you understand before we get to the setup. Because this connects everything. The big short sellers in silver aren't just randomly betting on price. Their short positions serve a function. They suppress the price of silver to indirectly protect the perception of fiat currency strength. Here's the logic. Gold and silver are historically money, real money. When their prices surge, it signals that paper currencies are losing purchasing power. Central banks and the financial system have a structural interest in keeping gold and silver from sending that distress signal loudly and clearly. So the shorts in the paper market act as a pressure valve. They bleed off price discovery and prevent silver from doing what it would do in a genuinely free market. Understanding this is critical, because it means the manipulation isn't random profit-seeking. It's systematic, and it has institutional support, which means the squeeze, when it comes, won't just be some traders getting caught offside. It'll be a structural failure of a system that's been running on borrowed time. Now, there are 3 things that could actually trigger a real squeeze. And the third one is something almost nobody in mainstream finance is talking about. I'll get to that third one in a moment, but let me walk you through the first 2. The first trigger is a COMEX inventory drainage. When the registered silver inventory on COMEX, that's the silver actually available for delivery, drops to critically low levels, it becomes physically impossible for short sellers to make good on delivery obligations at current prices. They have to either buy at whatever price the market demands or default. We've seen registered inventories fluctuate dramatically over the last 4 years, dropping sharply during periods of industrial stress. When that number starts falling consistently, pay attention. The second trigger is a currency crisis in the dollar. If the dollar weakens sharply against a basket of major currencies, commodities priced in dollars naturally rise as a mathematical consequence. But silver gets a double effect. It rises from currency debasement and from the sudden rush of investors seeking monetary metals as a store of value. You get industrial demand plus safe haven demand hitting at the same time. That's a demand shock on a market with already limited supply. Now here's the third trigger. And this is the one that genuinely keeps the big short sellers up at night. Sovereign nation accumulation. There have been credible reports and partial disclosures suggesting that certain nations, particularly those looking to reduce dependence on the dollar-based financial system, have been quietly accumulating physical silver alongside gold. China's strategic reserves are notoriously opaque. Russia has been building commodity reserves. If even one major sovereign player decides to take a meaningful long position in silver and stand for delivery at scale, they become the agent that breaks the paper market. Because unlike retail investors, who can be shaken out by volatility, a sovereign wealth fund with a geopolitical agenda doesn't panic sell. They hold. And their holding forces the shorts to cover, which pushes prices up, which forces more covering. If you're getting real value from this breakdown, hit subscribe. I go deep on commodity markets, monetary metals, and the hidden mechanics of how big money moves every single week. And the next video is going to cover exactly how to position yourself for a silver breakout without overexposing yourself to the volatility. You don't want to miss that one. So let's talk about what this actually means for you as someone watching this right now. The way most people get silver exposure is wrong for a squeeze scenario. If you buy SLV, the iShares Silver Trust, you're back in paperland. SLV tracks the price of silver, but your investment doesn't contribute to physical market stress. There's no delivery pressure from SLV buying. The shares are backed by silver supposedly sitting in HSBC vaults, but you have no delivery right as a retail holder. For price appreciation in a bull market, fine. For participating in the actual squeeze dynamic, you're not part of the mechanism. Physical silver, coins, rounds, bars in your own possession, is different. Every ounce you pull out of the commercial supply chain is an ounce that's no longer available to be lent, shorted, or hypothecated by the paper market players. It's a direct removal from the system. This is why the silver stacking community, for all the jokes made about them, is actually doing something structurally significant at scale. Hundreds of thousands of individual buyers, each pulling hundreds or thousands of ounces out of the market, adds up. Silver mining stocks are another lever. They give you leveraged exposure to the silver price because their profit margins expand dramatically when silver rises. If silver goes from $25 to $50, a miner producing at $15 cost per ounce sees their profit per ounce triple. The stock can move 3, 4, 5 times the move in the underlying metal. But mining stocks come with operational risk, management risk, and they trade on stock exchanges where broader market sell-offs can crush them, even when silver is doing well. Use them with eyes open. Now let me pull all of this together into the framework that I use when I'm evaluating whether a silver squeeze setup is building or dissipating. I watch 4 things simultaneously. First, the COMEX registered inventory trend. Is it falling? Second, the gold to silver ratio. Is it above 75 to 1? If yes, silver is historically cheap relative to gold. Third, the commitment of traders report. Are the commercial net short positions at extreme historical levels, or are they moderating? Extreme shorts with falling inventory is the most dangerous combination for the short sellers. Fourth, physical market premiums. When the price of real silver coins and bars starts trading at significant premiums above the spot price, it means physical demand is outstripping supply at the paper price. That's the physical market telling you something the futures market is lying about. When 3 or 4 of those indicators align, the setup is forming. You don't need a prediction. You just need to read the signals. Let's recap what you now know. The silver paper market is 250 to 300 times the size of the physical market, which allows price suppression through concentrated short positions. JPMorgan Chase was literally fined over $1 billion for doing this. A short squeeze happens when rising prices force short sellers to cover, creating a feedback loop of higher prices and more forced buying. Industrial demand from solar, EVs, and tech creates a permanent and rising floor under silver demand. The real squeeze trigger isn't retail buying of ETFs. It's physical delivery demands at COMEX and potential sovereign accumulation. And the gold to silver ratio sitting above 80 to 1 tells you silver is historically undervalued relative to gold right now. Moving forward, when you see COMEX registered inventories dropping while commercial short positions remain elevated, watch closely. When the gold to silver ratio starts compressing hard below 70 to 1, that's the signal that money is rotating into silver. When physical premiums spike above 20%, the paper price is about to catch up to reality. You now understand what 90% of investors, including many professionals, completely miss about how silver is actually priced and traded. This isn't abstract theory. It's the documented proval mechanics of one of the most suppressed markets in the world, and one that, when it finally breaks free, could move in ways that look almost impossible from today's vantage point. I want to hear from you. Do you think a real silver squeeze happens in the next 5 years, or do you think the banks always find a way to maintain control? Drop your take in the comments because I read every single one, and this is exactly the kind of discussion that sharpens everyone's thinking. If this video gave you a real edge, hit subscribe. Next week, I'm breaking down exactly how to evaluate junior silver mining stocks, specifically the financial ratios and reserve quality metrics that separate the stocks that will 10x in a silver bull market from the ones that go to 0. You won't find that breakdown anywhere else, and I'm going deep on real company examples. Remember, the price you see on your screen for silver every day is not a free market price. It's a managed price. And managed prices, when the pressure builds beyond what the management can contain, don't correct gradually, they correct violently and fast. The question isn't if, the question is when, and whether you're positioned when it happens. Stay sharp.